Why did Warren Buffett just sell nearly 50% of his Apple stock? This move shocked the financial world and could have major implications for the future of Apple stock. Let's dive into why Buffett made this move, what it means for Apple, and what his next play could be. Warren Buffett and his company, Berkshire Hathaway, have held Apple as one of their largest positions for years. So why did Buffett suddenly slash his stake by nearly 50% in 2024, selling off billions of dollars in Apple stock? Let's explore the reasoning behind this surprising decision. Apple has been a powerhouse in the tech world for the past decade, and Buffett first bought in around 2016. The stock soared, and Berkshire's Apple holdings once accounted for more than 40% of their total portfolio. But despite its strong past performance, recent changes may have convinced Buffett that it's time to step back. First, let's talk about Apple's stock performance. Over the past 5 years, Apple's stock price has surged by over 230%, outperforming the broader market. However, this meteoric rise has also raised concerns about whether Apple's stock is now overvalued. Some analysts believe that after such a long period of growth, Apple's future growth may be more modest. And this might be exactly why Buffett is selling. He's known for avoiding stocks he believes are overvalued or whose future growth potential is limited. Looking at this chart, we can see Apple's incredible run. But such massive growth in such a short time can't last forever. Buffett might be thinking ahead, seeing less room for future gains compared to other opportunities. Buffett's investment philosophy is all about long-term value, not short-term stock spikes. And right now, Apple's heavy reliance on its iPhone sales is a concern. Although Apple's other services and products, like the MacBook and wearables, are growing, the iPhone still accounts for more than 50% of its revenue. Global smartphone demand has been stagnating, and with Apple's high price point, it might struggle to maintain its massive market share. This might have signaled to Buffett that it's time to lock in profits and explore other investments. Another key factor is Apple's buyback program. Apple has aggressively bought back its own shares, reducing its outstanding shares by over 20% in recent years. While this has driven up the stock price, it also raises the question, how sustainable is this? Buffett has previously praised Apple's buyback strategy, but if it's no longer driving value at the same pace, that could be a red flag. With share buybacks potentially slowing and smartphone sales leveling off, Buffett might have decided to scale back his position. Beyond Apple's specific risks, Buffett's move may also reflect a broader outlook on the market. In 2024, Berkshire Hathaway increased its cash reserves to a record $277 billion. This massive cash stockpile suggests Buffett is preparing for potential volatility or even a broader market downturn. By reducing exposure to Apple, he's diversifying his portfolio, likely aiming to minimize risk in an unpredictable economy. Building up cash reserves while cutting Apple might indicate that Buffett sees limited growth potential for tech stocks in the short term. With rising interest rates, inflationary pressures, and economic uncertainty, the tech sector, including Apple, could face headwinds. Buffett may be positioning Berkshire Hathaway to weather any storms ahead. So, what could Buffett's next move be? If he's pulling back from Apple, what's catching his attention? There's speculation that Buffett may turn to more traditional, value-oriented sectors like insurance, energy, or financial services. His company has already boosted investments in these sectors, which tend to perform better during periods of market volatility and economic uncertainty. It wouldn't be surprising if Buffett continues to shift towards stable, cash flow-generating companies rather than tech giants like Apple. Finally, what does this mean for you as an investor? Should you follow Buffett's lead and sell your Apple stock? Well, not so fast. Buffett's strategy is based on massive positions and long-term plays, which might not be directly applicable to smaller investors. However, his decision does raise important questions. If Apple's best growth years are behind it, and the stock is now trading at a premium you might want. Apple's current price-to-earnings ratio is higher than many of its peers, suggesting that investors are paying a premium for its stock. If future growth slows down, those high valuations might be harder to justify. In summary, Warren Buffett's decision to sell 50% of his Apple stock sends a strong message. While Apple has been a great performer, Buffett seems to be signaling that the risks may now outweigh the rewards. With concerns about iPhone dependency, the sustainability of stock buybacks, and broader market risks, Buffett is taking a cautious approach. The question is, should you be doing the same? Thanks for watching Double Dollar Club. Be sure to hit the subscribe button for more insights into the stock market and investment strategies that can help you make informed decisions.